Adobe is the company that has become a household name over the last decade. From Photoshop to cloud, they have everything. And now they've been in the news again where they stopped the Figma acquisition and will pay a $1 billion breakup fee. Is the stock maybe now a buy? Let's look into it. First of all, how do they make their money? They make their money in two segments, the digital media segment and the digital experience segment. Digital media is everything that they have from Photoshop to their cloud to their PDF reader. Their digital experience segment is more about marketing and analysis. And if we look more into the quarterly view, we can see most of the money comes from the media segment, and that is also what Adobe is known for. So when it comes to what the company makes, this is where we need to look at. Are they competitive here? Well, first we can see revenue growth at Adobe has kind of stalled. And this is one of a few tech companies where during the pandemic in 2020, their revenue growth has actually declined. Before they were at around 25%, during the pandemic they were at around 15%. And now that kind of makes sense, because if you think about it, Adobe makes their money by giving you, the creative user who's gonna use it to edit a picture, edit documents, a subscription, or rather your company buys a subscription for you usually. Everyone who needed it already had it before. Most people had to buy laptops now to work from home, but everyone who needed an Adobe subscription already had one. And with companies hiring less because, the economy wasn't doing too well during COVID, obviously less Adobe subscriptions were going to be bought. But after they started recovering from the pandemic, they went back to the 25%, but now they're declining again. They're growing at 10% right now, and that already for some time. And it's not like that is a one-off quarter. We can see all of the latest quarters were usually at around 10%. And that makes sense. If you look at graphic softwares, which is most of Adobe's business, like InDesign, Illustrator, and Photoshop, here, their products have a huge amount of the market. And if we look at projections at how much the creative software industry is gonna grow, in the US it's gonna grow at around 7%. So let's say 10% worldwide, because Asia and Africa are gonna be a bit faster growing than the US. Unless you increase your market share, which is already gigantic, that 10% is what you're gonna mostly have. And then it's also the question, are they gonna keep this market share? While Adobe products are fantastic, competition has been increasing. It was easy to grow back here, because Adobe was basically the only way. You had to use Photoshop, you had to use Adobe Illustrator. There were no real competitors. But nowadays, Adobe has a few competitors. Competitors like Canva, which I'm using for example for a lot of my stuff, or Figma are coming into the play. Now we gotta think, is their moat very big? Are they gonna be able to keep their revenue growth up? Are they gonna be able to keep their high prices? Well, yes, no. Their moat is very great. We can see their free cash flow margin is very high, 35% right now. That is a one-off though. We should look at around 40% they had before. But it is also not invincible. Otherwise, there would have been no reason to start the Figma acquisition. They were gonna pay $20 billion for Figma. And $20 billion is not little money for Adobe. In 2020, they made $7.3 billion in free cash flow. That is still an enormous amount of money for Adobe to spend on one company. While they have a great moat, it's not invincible anymore. And we can see this in their margin. They have been able to raise their margin until 2018, from 22% to 41%, but ever since then, they have not been able to grow their margin much. It has basically been flat, and Adobe products are very expensive. So I think when it comes to their margin, they have reached the maximum of what they can squeeze out. And this is not a one-year situation, it has not been growing for 5 years. This shows us the moat is not infinite here. So when I look at this company, we're gonna have around 10% in revenue growth if they keep the market share up. Basically no margin growth, but buybacks. Adobe always has buybacks. Well, yes, they buy back around 1 to 2% of a share's big each year. Plus, at the same time, share buybacks are gonna have way less of an effect because of the exploding share-based compensation. Since the beginning of 2020, share-based compensation has nearly doubled. Well, free cash flow has not. And if to look at it more extreme, since 2021, the free cash flow has basically not moved, while share-based compensation has increased by 800 million. So in reality, over the last 2 years, you had a massive loss of free cash flow. Now, do I think this is gonna continue forever? No, but this makes me worry a lot. This share-based compensation is exploding, while the company is not back in 20% growth mode. And at the same time, Adobe has grown not only with internal products, but they have also done huge acquisitions from time to time. So if all this growth you have is not only internal, some of the free cash flow will have to be spent on acquisitions. Now when it comes to valuing a company, last quarter was a one-off for the free cash flow. I don't think it's gonna be that low. Let's count around with 7.6 billion of free cash flow, minus the 1.7 billion in share-based compensation. Let's be fair to the company and just call it 6 billion. That would be around $13 in free cash flow per share. No dividend, they don't pay out a dividend. Let's say they will grow at 13% for the next 5 years. That includes 10% in free cash flow growth just from revenue growth. That assumes that free cash flow will continue to grow faster than share-based compensation again. And that is already a risky assumption. 2% in buybacks, 1% in margin expansion per year. That is very, very aggressive, I would say. I wouldn't count with this. Their margin has stayed flat for 5 years. I don't see any reason why it would go higher, but I just want to give this company a chance, because otherwise this makes no sense for valuation. Slight slowdown in revenue growth, 10% discount rate, 18 multiple. It is still a great company. It has a good moat. It deserves a higher multiple. Well, $243 per share, which is 57% below their current value. But finally, when the stock crashed in 2020, it was around that amount. Now, what if it goes better? We're going back to 20% growth again, 15% afterwards, 25% for the company because it's fast growing. Then we would slowly come into the territory where the stock would make sense. But that assumes competition is going to disappear for Adobe, their margins are going to grow again, and that the 25 multiple is going to happen. Now, what if it goes slightly worse? Their stock-based compensation continues to explode. Revenue growth slows down even further to maybe 8%, 2% buybacks, 15 multiple, $164 a share. Overall, Adobe is a great company, but I see a few red flags. The huge amount in acquisition costs, the huge stock-based compensation, and the slowing revenue growth. It has fantastic products, and I would love to eventually own it, but not at these prices. What do you think about Adobe? Write it down below. Have a good day.